Hey folks, this is Clayton Collins, CEO at HW Media and your host for the Housing News Podcast. I have religiously followed the analysis and surveys and forecasts put out by the Mortgage Bankers Association for years. And today's guest is one of the leaders that leads that effort of analysis, surveying, and forecasting for the MBA. Marina Walsh, Vice President of Industry Analysis at the Mortgage Bankers Association. Marina has been at the MBA for 22 years, which is really significant because it means that she's seen multiple cycles and has been in charge of research and analysis since before the GFC and seen some of the trends change, not only in the data, but also what the membership is looking for in terms of knowledge and intelligence. In today's conversation, we talk about profitability, we talk about home builders, we talk about the depository and independent mortgage bank mix of industry market share, servicing, and we even go into forecasts for the remainder of 2023. I hope you enjoyed this conversation with Marina Walsh, Vice President of Industry Analysis at the Mortgage Bankers Association, as much as I did.
We may have just gotten back from Gathering of Eagles, but we're not done with events for 2023 yet. This October, we're headed right back to Austin, Texas for HousingWire Annual, and we want to see you there. We've got a power-packed agenda with content such as our Women of Influence speakers, peak performer playbooks, CEO playbooks, and more to propel your company forward, as well as a bunch of networking events. Because this event is open to real estate executives, mortgage, title, and everyone in between, you really have the opportunity to network with people from all across the housing ecosystem. If you want to learn more about the event, or if you're already ready to get registered, head over to housingwire.com on the events tab and you can learn all about it. Not to mention, if you're an HW Plus member, you're going to get 50% off your ticket. So get registered for HW Plus and get registered for the event so we can see you out in Austin.
Marina, thank you for joining us for an episode of the Housing News Podcast. Thrilled to have you today.
Great to be here, Clayton.
Our listeners have gotten pretty used to the topics that we cover on Housing News, where we're usually speaking to C-suite leaders in the mortgage banking or real estate brokerage space, or digging deep into data with some of the economists and analysts and experts that understand this industry at the fullest. So I'm thrilled to be able to dive into some of the housing market and mortgage data that the Mortgage Bankers Association and your team has brought to the forefront consistently for years, and that many of us rely on for a pulse of what is happening in the housing economy. I'd love, before we jump into the data, I'd love to hear kind of a quick overview of like how your career led to this point where you are one of the most foremost experts on mortgage data that we all rely on every week.
Wow. Okay. Well, I'll get started. I'll say that I've been with Mortgage Bankers Association quite a long time. I've been with them 22 years, which it's just flown by through the good and the bad, through many mortgage cycles. But where I first started out in mortgage was working at Ernst & Young in their Federal Credit Advisory Services group. And of course, I get put on a mortgage banking project working on Ginnie Mae credit programs and different federal credit programs. And so that was sort of my introduction to mortgage banking. It's really interesting because, you know, in this field of mortgage banking, people have very different backgrounds, but I fell into it. And then one of the people that used to work at Ernst & Young eventually moved to Mortgage Bankers Association, and then I followed her. So I've been here a very long time, through thick and thin, raising my kids, and always in research and economics, Clayton. So I've been working on benchmarking and, you know, expanding my scope as the years go on.
Marina, today we're going to talk about some of the reports and data that you're in the MBA are really, really known for, like the industry profitability study and some of the application indexes. And we're going to go in and talk about servicing. But I'm really curious, in this 22 years in economics and forecasting at the MBA, how some of like the focus areas have changed. And like, if I if I do the math on 22 years, we're going back to the years that led up to the GFC, kind of the boom years of mortgage in the early and mid 2000s. And I'm curious of how like your economics team focus has changed through cycles, and like kind of what type of research and survey work and reporting has been valued by the membership that relies on you for intelligence.
Ooh, now that's another loaded question. I would say there's much more of a focus now on the cost of compliance.
Yeah.
From 2010 onward, when you think about Dodd-Frank and the changes that made to the industry as a whole, there's a need over the years for much more granularity, understanding profitability of different segments, whether that be banks versus independents, small versus large, different product types, heavier government versus conventional conforming. So again, the need for more granularity to really figure out, what are the pockets, what are the market opportunities out there, I think is a pretty big change while staying compliant,
Yeah.
of course.
Last night, I was at a small gathering and dinner hosted by our friends at AIS here in Dallas, and they do outsourcing and work particularly around like the servicing space. And the group that was together was pretty bank heavy, like mortgage leaders inside of the depositories. And I honestly felt like I walked into like a whole different dimension in terms of like the focus areas. And I bring this up because you mentioned compliance. So like one of the comments that came up again and again is that like when they're listening to vendors and vendors are keep kind of hitting on that like cost control mechanism, like some of the bank mortgage leaders are inside are like, all of my priorities are set up around compliance, security, risk management, not necessarily around cost control. And I'm like hearing this kind of like mind blown because here in like the IMB world with the independent mortgage bankers that we spend so much time with, the cost control and like business growth and margin management like have been topics that are so front and center. Do you see a like inside of the membership like a focus on like different data points that like mortgage banks versus depositories consume or care about or ask you about?
Absolutely. The big change, I think, or one of the differences rather, is on the bank side. Oftentimes they hold their loans in portfolio. So going back, they kind of look at profitability differently.
Yeah.
So they have that net interest margin associated with portfolio loans. Now, for the purposes of our benchmarking and comparing banks versus independents, we don't include that net interest margin in there. So we ask them to sort of impute or estimate a value for their servicing right and their secondary marketing gain, even though that's not in accordance to GAAP. So big focus among banks is what can they hold in portfolio? So when you think about the change in the market, in January, I would have said, wow, advantage banks, because they're going to have this portfolio product, whether it's ARMs or jumbos and so forth, on their balance sheet. Able to expand into other products. And March really threw that up in the air, right? And so there's much more scrutiny at the board level within banks over what is held in portfolio now. So yeah, very, very interesting times in terms of independence versus banks and who's going to come out on the other end. I would say, we talk about banks and cost controls. There have been some notable layoffs as of late on the bank side. Those happened on the independent mortgage bank side, for over the past year. But that's starting to come out too. So it's not as if they just have free reign, for sure. There is definitely an important focus on regulation, on security, as you mentioned. And so in general, banks' corporate costs on a per loan basis are higher than independents, but independents are certainly focused on regulation too and compliance. So those costs are going up for them as well.
It seems like the banks, if March hadn't happened, if we hadn't had this SVB debacle that like kind of shook the whole banking system, I was going to say like regional and specialty, but it extended far past that. I think the depositories could have written as much jumbo business as they ever wanted, and probably still could write as much jumbo as they ever wanted, but start to bump up against regulatory thresholds of what can be held on in that portfolio.
Absolutely. And I would say whether you're a bank or an independent, in our credit availability index, we see a movement towards simplification.
Yeah.
Just the opposite of what we saw in the 2000s after the refinancing run-up of 2003. Mortgage lenders were trying to retain volume, originating exotic products. Now, with this turn of events in terms of volume, we actually see mortgage companies just trying to simplify their products to reduce costs. So it's interesting to see that dynamic.
When you say simplify products, do you mean tighten the breadth of the product suite, or like what does simplify products mean?
Absolutely. Focus on what they do well. So they may not be offering 30 different mortgage products out there. We see it in our credit availability index. And so, just sticking with what they do well, the vanilla, conventional conforming, or government product.
And then it seems, tell me if I'm wrong here, but the one product it seems like everybody, banks and independent mortgage banks, is trying to or has recently launched is home equity, though, right? Like, isn't the home equity product like kind of the outlier on, hey, we want to add this to the portfolio?
Yes, I'm so glad you mentioned that, because we are going to release very soon our home equity lending study publication. We took a sabbatical from our home equity lending study for a year when a lot of lenders got out of the space. There was cash out refinancing. There wasn't a need for home equity. But given this accumulation in home equity and the fact that many existing homeowners are sitting on very low interest rate first mortgages, I think there's definitely a huge opportunity in the home equity space. If existing homeowners don't want to move because they don't want to lose that first mortgage rate, they could potentially renovate. So the move up buyer may have second thoughts about moving into a new home and will consider renovation. So that seems to be where the focus is based on our study. I'll just give you a sneak peek into the results, but renovation being a key reason, and that still has the tax benefits associated with it.
I'll like wave my hands in the air to like get Sarah Wheeler's attention and to put it on your radar, Marina. Like, we would love to like partner with you on publishing that study and bringing more home equity content to the HousingWire audience. So like, please like make sure we follow up on that, because I'd love to make sure that we're a partner with you on bringing that awareness of the study to our audience, because it's something that we're thinking a lot about.
Absolutely.
Okay, so all right, so we've talked about profitability. I would love to like step back a level. The industry, or the independent mortgage bank profitability study that the MBA has completed and published for years, has been a front and center topic on the pages of HousingWire, as well as in conversations with executives across the industry. Can you give us a glimpse into the, like, I know this is probably a 45-minute question in itself, but like the methodology and significance of the study. So like, why does the MBA do this study, and what should industry professionals take away from it?
Sure. I'll start out by saying we do multiple profitability studies.
Okay.
So our most frequent and the one that's publicly available is our quarterly performance report. It has over 300 mortgage lenders included. It's based on a data feed that we receive from Fannie and Freddie and Ginnie as part of a consortium agreement, whereby we are given the mortgage bankers financial reporting form data to use in industry statistics, as long as the companies agree to release the MBFRF data to us. So again, companies, if they do business with Fannie, Freddie, and Ginnie, if you're an independent mortgage company, you're required to submit the mortgage banker's financial reporting form, and we take it and convert it into something that'll help the industry. So it's important to keep in mind that that particular study does not include many banks. There might be a few bank subsidiaries sprinkled in, but really it's an independent mortgage study. And so it's great and current because we have quarterly data on it, but we also have more boutique detailed benchmarking studies, such as our MBA and Stratmore Peer Group Roundtable program and our Servicing Operations Study and Forum, that really do deep dives into both production and servicing. So that's sort of the suite of what MBA offers in terms of overall profitability. And then, of course, we have other studies related to, volume, delinquencies, compensation, and so forth.
So in the HomeBuilder reporting, and this number will likely get smaller this year, there's over 4,000 mortgage lenders in the country in the 2022 study. I'm sure that'll have a 3 handle on it in 2023. But you're hitting about 10% of the active mortgage lenders in this survey. The lenders that are not included in the survey, have they opted out or maybe fall below a size threshold? Like, what's the methodology on getting to those 300 that are selected in the feed?
Yeah, in the feed, it's really based on the data that we get. So they have to be independent mortgage companies that do business with Fannie, Freddie, or Ginnie.
And you're right. So the HMDA list is inclusive of depositories and credit unions and like other models for.
Correct.
Okay.
Correct. That includes it. And in addition, again, it doesn't include the small independent mortgage companies that sell their loans on a whole loan basis to correspondents solely and don't have their Fannie, Freddie, Ginnie tickets. So that's part of it. Yeah, it's a smaller sample, but it really ties nicely into some of our other benchmarking studies. We see very similar results for independent mortgage companies between our various studies.
That's interesting. So do you think is 300 like kind of a proxy for the number? Is that the number of independent mortgage banks that have their Fannie, Freddie, Ginnie ticket? Like, is that
absolutely
really?
Not?
Okay.
No, we go through a process. First of all, some of them don't release the data to us, but we also go through a process whereby if we feel the information is not complete, and again, it's a matter of focus. I think the agencies are very focused on the balance sheet, whereas we're a little bit more focused on income statement items. And so if there's not the breakouts, for example, of expenses, or if there are certain fields that are incomplete, we take them out. So the overall number of Fannie, Freddie, and Fannie, Freddie seller servicers and Ginnie issuers is certainly higher than that.
Okay. You mentioned the balance sheet, which kind of reminded before we went on air, we talked briefly about an article that HousingWire published this week. Bill Conroy wrote an article titled "Many Mortgage Lenders Are Like Frogs in a Slow Boil," which is a powerful headline. But one of the main points in that article was balance sheet. So like one of the concerns of why there may be less independent mortgage banks at the end of 2023 and there was 2022 is how many lenders kind of fall out of their covenant agreements with their warehouse lenders off of net worth, aka balance sheet is not strong enough to support continuing to access capital and sell loans. And we had a lot of information and data in there from Stratmore, who's a partner in your study. So how do you I don't know, do you have any insights or topics you want to talk about related to balance sheet and how?
Sure.
Yeah.
Yeah. I'll start by saying, balance sheet, of course, is related to income statement. So on the income statement, I mean, for the first time ever since we started this report in its current format in 2008, we've had 4 quarters of net production losses. So how can that happen? Usually we don't see that. We might see 1 or 2 quarters, but to have 4 quarters of net production losses is very unusual. And how is that possible? Well, if you think about where we were 2 years ago, where we had triple digit net production income, uh, mortgage companies were cash rich. They had a lot of cash, which gets to the balance sheet. And so if they were prudent, they were probably saving that for a rainy day. So they had the cash on hand. And now we're seeing it in the balance sheet where just if you look at just cash and cash equivalents, that's slowly dropping down. That might be an interesting chart of the week for MBA. But if you look at the cash and cash equivalents over on a quarter by quarter basis, that keeps on a repeater company basis going down. And so they're slowly eating into that nest egg, so to speak. And it's just a matter of how long can they continue before that gets depleted, which is probably the basis of your article that you mentioned, Clayton. So I spoke to a lender the other day and I said, wow, 4 quarters. And one lender said to me, oh, we could go another 4 quarters. We have the cash to do it.
And that's amazing, but that is a really unique place to be in. And like a big theme we've been trying to hit on is the lenders who position themselves. And you referenced earlier, the independent mortgage banks who got their P&Ls in shape last summer. It was ugly at the time, right? Like there were headlines about layoffs and cost reductions. And I think some of the players who were super early in sensing where the market was going, they looked weak when they did major like headcount reductions. But in the end, or where we are today, they positioned themselves to play offense and actually have the cash reserves to stay in the game longer than their competition.
Yeah, but it's hard. I go to these conferences and folks, I feel like they're going to start throwing rotten tomatoes at me because I show these charts that show this, study high $13,000 per loan in costs. And it's just it's really hard because many of them say, Marina, we're down to the bone. We need our loan officers in place in order to get production in the door. So there's only so much cutting that we can do. And we did have another chart of the week that I think, Clayton, is really interesting that looks at those per loan figures, 13,000 per loan in losses versus same store gross expense reduction. And if you look from peak to trough, there's been expense reduction of 58% based on our quarterly performance report.
13,000 is the cost to originate, but the loss has been in like the 2,800 range in Q4 and
Sure.
2,000 range in Q1.
Mm-hmm. Yeah.
Okay.
Yeah. It's been in that range. I like thinking about net production income in terms of basis points, but negative 68 basis points. But again, in terms of gross costs, 58% drop from peak to trough in terms of where we are. So it's not as if these companies have just been sitting around twiddling their thumbs. It's just the sheer change over such a short period of time. 10 Fed funds rate cuts, or increases rather. Oh, goodness, we wish. Increases plus potentially another. If you just think about this, the sheer change in volume, and it's even more pronounced when you look at units instead of dollar volume. If you look at the unit count, which by the way, MBA is tracking now, it's even more of a decline. So just in 2023, we're talking about a 26% decline in units. So the unit volume in 2023 will be the lowest in over 2 decades. We went back and started to look at that. So, it's just, I hate to use the word unprecedented because it's used over and over again. But again, I have never seen anything like this. It's just, it's definitely a different environment. I thought in 2008, 9, 10, when we had the Great Recession, we did have a period in which rates were dropping. We had HARP volume, we had HAMP volume, there was volume coming in. But this is just, again, a different situation, with low housing inventory, just no housing inventory out there. There's plenty of demand. I think even with rates where they are now, I remember when I got my rate back in year 2000 and it was, maybe 6.75. And I said, woohoo, 6.75. That's great, But we have this situation, the structural undersupply of housing, which is adding another twist to things, a huge twist.
All right, I promise the audience will tell the story how it is. So like they're hearing the negative, like the inventory sucks. Cost to originate has come down, but it's still high. On a positive note, the survey for Q1 did show that the net loss for IMBs had come down from 2,800 in Q4 to 1,972, so just under $2,000 per loan in Q1. So like, hey, still losing money on every loan, but not quite as much as before. There was a few things that jumped out to me though that were also silver linings. So like 32% of companies were profitable in Q1 compared to 25% from the prior quarter. Can you go a little bit deeper on other like silver linings or maybe surprises that you've seen in this survey or other surveys that have come out in Q1 or Q2? We're having this conversation in the beginning of August. So like we probably have a glimpse a little bit into how Q2 played out.
Sure. Well, on that 32%, keep in mind that includes both production and servicing. So on the servicing side of the operation, if you have servicing, things are holding up pretty well. There's cash flows. Defaults are quite benign right now. I think based on our latest national delinquency survey, we were at the second lowest level of delinquency since 1979. Yeah. So things are holding up in terms of the cash flows on the servicing side. Last year we heard a lot about the write-ups of mortgage servicing rights because of the lower prepayment activity. That certainly helped too. So I will bring that to the attention that 32% includes both production and servicing. But in terms of silver linings on the production side, I would say it's a great time to be affiliated or have very strong partnerships with builders. When we're looking at the data now in terms of the for sale housing inventory, about 30% are new homes. And so really that's sort of where things are right now, because existing homeowners, again, unless they have to, and there's some sort of personal event, they aren't going to want to move and lose their 3% or thereabouts first mortgage, 3.5, 4% mortgage. And so really where we're seeing the silver lining are those that have those relationships with builders or are able to capture new home sale financing. Yeah.
Working with builders always seems to be a little like point of contention for some mortgage lenders and real estate brokerages that often feel like they get cut out of the process. And one of the things that we've seen in our beat is that builders have been able to be more aggressive with rates, and there have been buy downs, and so kind of captive or associated lenders with builders box out other originators in that market. Now they're doing this in the compliant way, but it's still it makes it hard to compete against. How are you seeing mortgage lenders effectively work with builders, or is this opportunity you're referencing more so hey, go get a JV with the builder or else you're not playing the game?
The data that I see would be those that are builder affiliates or have those JVs in place. That's where other than having individual at the regional level, having those personal relationships.
It's hard. I talk to originators who have their realtor partners have 100% aligned on with local builders, and and that sucks up the mortgage referral. So realtors that originators have worked with for years are now sending everything to kind of the JV or affiliated builder partner, and it surpasses the relationship, because if a builder can offer a 5 or 5.5% interest rate, and the market rate is 6.5 or 7, they're doing what's kind of best for the consumer by making sure they land in that funnel.
Yeah, I would say, that is one segment that's doing well, but there are still life events. As I like to say, mortgage product is not simply going away. Certainly the pie is getting smaller, but the 30-year fixed rate is here to stay. It's here to stay. And so, there are life events. There is a floor. It's not just going to disappear in smoke like the Betamax or the Palm Pilot. And if you don't know what those are, I'm way too old.
I didn't have a Betamax, but I still rock the HP 10B2 as my. So this is still okay. So Marina, when we were prepping for this conversation, we also talked about servicing. You've mentioned servicing a few times and how it impacts profitability. The MBA also does a phenomenal job tracking the servicing market with the National Delinquency Survey and the Loan Monitoring Survey. Give us a glimpse into how servicing portfolios are performing. And I'd love to also hear a little bit about how your members are thinking about servicing today in terms of their strategies of retaining or selling, and how that plays into the overall business model.
Sure. I mean, right now, the delinquency rate is tracking almost right on top of the unemployment rate, sitting at about 3.6%. And so if you want to think about what may happen to delinquencies going forward, look at the unemployment rate, because we've seen that trending now for almost 10 years where they're really, really in sync.
Yeah.
So we're still at a good place. We're expecting in our MBA forecast, we're expecting a slowdown, soft landing, mild recession, however you want to term it. It's baked into the forecast, and so the unemployment rate is going to go up a bit, and so that's important to keep in mind. We're sort of at the lowest point, but servicing, to your second point, is it is valuable. It was especially valuable last year because those independents that needed cash fast were able to sell mortgage servicing rights at a pretty nice clip, and generate some additional profit / cash for their organizations. And then there are those that are able to retain the servicing, hold on to it, and they have those ongoing cash flows. Costs have flattened out over the past 3 years. Overall, based on our servicing operations study, we're looking at about fully loaded $240 per loan per year is what we're looking at. But, the expectation is, particularly with these post-forbearance workouts, if there's any type of deterioration in the performance of those, that's going to be additional costs. And so, the cost of those non-performing loans, especially as the waterfalls, the loss mitigation waterfalls might be changing. The agencies, Fannie and Freddie, have already announced changes to the waterfall in the spring, and then FHA is still working through that. So any of those changes need to be operationalized, which costs money, obviously. And then the future of forbearance, where is that going to sit? Is it going to be the same as it was during COVID, where there's a no documentation kind of option for forbearance? Because again, before COVID, we really only used forbearance for natural disasters more than anything else. But if there's a normalizing in forbearance, that's another that's another pretty big change for mortgage servicers as we enter a potentially higher delinquency environment.
I had the pleasure of in July hosting a secondary market masterclass. So we dropped 4 podcast episodes on the secondary market in this Housing News podcast feed. And the last episode was with Caroline Payne as a co-head of capital markets at Movement, and Greg Richardson, who's EVP of capital markets at Premise. And he used to be at Movement and worked with Caroline. It's a fun conversation. But one of the things that stuck out to me has at Movement, they had, and I don't know how long this has been in place, but they've kind of operationalized servicing and quality control inside of the capital markets group, which like when you look through that vantage point, makes a lot of sense if capital markets is in charge of liquidity. And kind of pulling it back to your like earlier comments on the lenders who have the ability to keep spending and like holding on longer than their competition. It seems like some of those lenders are the ones who had large servicing portfolios that they can find liquidity with and use that to like gain market share over time. Does that seem to be a strategy that you see some IMBs taking, like selling servicing to like stay in the game? Or how do you see people using those portfolios?
Well, you have the big public companies and banks who can retain servicing. I do think there is an advantage right now to volume in that space, because during COVID, you had a lot of independent mortgage companies that were simply retaining servicing for best execution purposes, right? And so it just made sense because it was basically servicing they got for free at that point in time, and margins were so good and they had the extra cash and so forth. So those, as these loans start to age, it kind of makes sense. And especially since a lot of those independent mortgage companies were using a subservicer anyway, and they may not have had a sophisticated servicing portfolio retention arm for the purposes of originations. Although I'll say, as an industry, the numbers are abysmal. I think the customer retention based on our latest data was at about 15%. So borrowers pay off and only 15% go back to that lender servicer. That's, somewhere that we need to work on as an industry. But
you keep saying it matters, but loan originators move around and change shops. So there's not like that loyalty that develops with a brand, and the lender sells servicing, and they don't stay in touch. Like, it's like, it doesn't matter how much lenders invest in like the CRM and like customer relationship strategy. Like, it just feels like if you don't have originators bought into building customer for life culture, like that 15% number is just going to linger. And it's almost like it's not 15% because those 15% came back. It's just like happenstance. It's like, oh, I shopped around 7 different lenders and I happened to land at the same one again. It almost feels like, I don't know, not a lot of loyalty amongst homeowners.
Not yet. The last time we had loyalty was really in 2012 with the HARP refinancings. There we got up to about 35% in terms of customer retention. But yeah. Okay.
So Marina, you mentioned the MBA housing finance forecast. This is a report that I've followed pretty religiously for years. The most recent report that I saw actually dropped in June as we're having this conversation in early August and dropping this episode in early August. Give us a glimpse into what the MBA is forecasting for the year in terms of total origination volume, anything of note in kind of purchase or refi mix or rate forecast. I'd love to kind of hear your view on some of those fields that the industry, most executives in the industry do read and then keep in their head. It's an important talking point for developing strategy.
Yeah. And I tell you, as I mentioned before, it's really important to look at both dollars and count, because there's a huge difference. I wish I could show it on the screen right now, the difference. But if we're looking specifically at dollars, which folks are used to us providing, if you think about where we are right now, we're going to end the year at about 1.8 trillion altogether. Refinances really low at about 391 billion for the year. And so that's the remainder for the year. So 2023 is really at its lowest point. From there, we're expecting rates to drop down a bit from where we are. There's plenty of room in there. If you look at the 10-year treasury versus the 30-year fixed rate, there's this wide differential in, that spread is what, 300 basis points or so. So there is room once we get a little bit more transparency in terms of what the Fed is doing, in terms of just economic indicators that aren't so mixed like they are now. There's plenty of room for those mortgage rates to drop down a bit. So again, this is sort of the worst, at a little shy of 1.8 trillion, going up to about 2.2 trillion in 2024, and then about 2.5 trillion in 2025. Now that's the dollar volume, okay? And then now I have to give you the counts. So in terms of counts, as I said, we're at the lowest point ever. So in counts, we're talking about 4.4 million loans originated. A little
And
bit
for anyone
shy of
not
that.
connecting the dots here, like volume is up compared to counts because of home price appreciation. Like houses are more expensive, mortgages are larger.
Exactly. If
Yeah.
you look at the conventional conforming, the new limits, they're very high in high priced areas. It's higher than $1 million. So yeah, that's making a big difference. Home price appreciation, it's, things are holding on. It's flattening out a bit, but we certainly, except in certain pockets of the country, nationally, we're not anticipating much in terms of home price depreciation. It's just a slowing in terms of the appreciation, and that's a change actually in our forecast as of late. I will say that.
So we have this 1.8 trillion projection in volume in 2023 with 300 billion of refi volume. How does that mix change in your 24 and 2025 forecast? I've heard a few mortgage banking executives kind of go out on a limb and forecast some big refi opportunities in the years ahead. And I'd love to hear the MBA's take on if that mini refi boom is something people should anticipate or kind of brush off the shoulder.
Yeah, well, it's all a matter of how you define big refi boom, okay?
300 billion to 500 billion.
How that's defined. If it's relative to the previous year, then maybe we're getting somewhere. But the refi share is only about 22% in dollar volume. It's about 22% and then 24% in units in 2023. So that's going to go up to 27% next year and then 28% the following year in 2025. But I see the point. The point is that, it's that old adage, what is it? You marry the house and you date the rate. So
I've seen that little adage has been updated. The last one I saw on Instagram was divorce the rate. It's getting much more. It's getting.
Yeah, maybe it should be divorce the
more,
rate sounds better. Yeah, exactly. But today's home buyer again could potentially be in the money 2-3 years down the road, potentially. But are we going? Unless there's some huge, scary, catastrophic event that we really don't want, some world event happens like a war. I mean, I don't imagine it's not baked into the forecast going down to a 2.5%, 3% mortgage rate.
I will pound the tables and say we do not want to see what has to happen to our world to get back to 2.5% again. Let's remember where we were
right,
when at the lows. I mean, we had civil unrest in our country. We had threat of World War III and a pandemic going on simultaneously. We don't want to be there.
No, we do not want to be there.
Yep.
You got that right.
Okay. So Marina, wrapping up this conversation, which has been amazing. I love your insights and I love the data. What data points or economic announcements should we be watching as we look forward into the month of August and the remainder of Q3? Where should our eyes be as we look to watch the metrics that matter for this industry?
Yeah, well, always inflation, unemployment. If you think about the purpose of the FOMC, the Federal Reserve, it's pricing stability and quote full employment. So always important to look at inflation, what's happening in terms of employment. I would throw in overall GDP. And I would also pay close attention to what happens in the second quarter for mortgage industry reporting on a profitability standpoint. And we'll have the second quarter data available the third week in August. That will really give us a good sense, along with all the public company information. It'll give a good sense of just how far we have to go, and are we kind of reaching the end of this valley, or are we still in the valley? And so more to come on that. Again, please be on the lookout for our second quarter data coming out the third week in August.
We'll definitely be on the lookout for that. And I'd love to, when you talk about some of the public announcements that we're going to see, I'd love to do some analysis and reporting. Maybe we can partner on this of like comparing the like the 10 Qs of some of the public releases to what we're seeing in the survey, and kind of seeing how like most of the public players are in like top 15 home lenders. So like seeing kind of how like that top largest tier compares to the median would be really interesting analysis.
Absolutely. Yep. We track that. We don't publish it, but we do track it. And I will give a shout out to one of our partners, Boston Consulting Group. They do a fabulous job, and they have a quarterly report that now is available on our MBA website to members. Has a lot of that analysis of public company data.
Awesome. I'm blanking on his name, but I met a gentleman from BCG at MBA Tech this year. KBW did a dinner, and there was Micah. Yeah.
Yes. Yeah.
Okay.
Jindal, I hope I'm pronouncing that right. Oh, Micah, if you're listening to this, I hope I did that right, because we just did a webinar together. But he heads up the mortgage banking practice.
I got to get Micah on the podcast, and I'll make sure we get the name pronunciation right when we do that. All right, Marina, thank you so much for sharing your expertise and time. I learned a lot from you. Hope our audience did as well. Folks, if you did find value in this conversation and take some notes, like please go into Apple Podcasts and give us a rating. Helps more people discover the show and learn from amazing guests like Marina. Marina, thank you so much.
Thank you, Clayton.